Hi, everyone, and welcome to a special edition of the AI Risk Reward podcast. It's a live stream, and we're here with Adam Parker today. So, Adam, welcome to the show.
Yeah, thanks for having me. Great to see you out.
So, a little background on Adam. He's got a PhD in statistics. He was the number one institutional investor semiconductor analyst. He was the chief U.S. equity strategist and global director of quant research at Sanford Bernstein. He then had the same job at Morgan Stanley. He's the founder of Trivector Research. They just kicked off Trivector Research, which we'll talk a little bit about in a few minutes. And look, I think we just got to, obviously, we've got to kick it off with the correction in virtually all the U.S. indices. Adam, what's going on here? What do you think?
Well, when we did our year-ahead outlook for institutional investors, we sell research on U.S. stocks to institutions in our Trivariate product. We kind of said, look, for the first time in 2-3 years, we were cautious. We thought it'd be volatile and down. Our call really started with the election night where we wrote buy the election, sell the inauguration. That kind of panned out because the bull case to us looked less juicy. And I'll give you 4 or 5 points. One is, it just seemed like, it sounds dumb to say this out loud right now, but at the time in early January when we wrote it before the election, what we wrote was we didn't think tariffs and dollar strength and other policies were in the price. Now it seems obvious, but people weren't really talking about it until really 2-3 weeks ago. The poly market, which I think we all learned during the election night is the most accurate gauge of what's going to happen, still has the probability of a large tariff as less than 50%. So people don't really believe, even with the price action in the market, that they're going to be a sustained long tariff. So that's one issue policy. Two is, profit margins, gross margins are all that mattered for stocks the last couple of years. And I think we transition now to revenue growth and acceleration mattering. And the fact is the U.S. consumer has just slowed a little bit. There's just too many data points for you folks to ignore, whether it's Walmart's guidance or the airlines or Dick's or Kohl's, or, you can go down the line, Target, with no growth, et cetera. So I think the consumer slowed a little. The data from conferences that institutional investors go to, whether it was Ray J a couple weeks ago or Morgan Stanley Tech before that, things are slowing a little bit, and they've slowed since mid-February. So I think that's another issue where you worry about policy creating, some inflation, you worry about slowing growth, and you have a growth scare that maybe is even morphed a bit into an actual growth slowdown. It's not just a scare. And then I guess lastly, you started this year, you couldn't romanticize you were a contrarian bull like you could the previous couple of years, right? Everyone who had been bearish the last couple of years now got kind of a more optimistic 7,000 S&P, and it just sort of felt like if you wanted to zig when they zag, you had to be more cautious. I think, I don't believe right now we're going to go into a recession. At least that's not the base case, and I think we'll find our chance. Every part of me wants to, now that in the last week, all the big firms have gotten bearish again, every part of me wants to get bullish again. But I honestly think it's too early because I think I need to see one of two things. And you'll know this from your, career as a stock, risk manager at a big firm is, you need to see April guidance. You need to see what the companies are thinking about their results and guidance. And then even better would be a company guides down and the stock doesn't go down. If I could get some signal like that, I would probably want to get on board. But I just think things are slowing enough that it's a little too early to get excited about taking risk.
Yeah, look, longer term, putting the risk manager hat on, policy-driven mistakes, which is what this looks like, are the easiest to fix and the quickest to resolve themselves. Now,
Yeah.
that may or may not happen this time, but it's not like the pandemic or banking crisis or
Right.
something which is...
They're not going to do the huge fiscal stimulus they did, financial crisis and others. And I think, investors maybe thought, or the narrative on the news was, oh, there's a Trump put, and it's, they'll if things go down a few percent, he'll just stop doing what he was doing and fire that person and start over. But, Bessent, the Treasury Secretary, and Trump have kind of said in the last week, like, that put might be lower than you thought, right? Like,
Yeah.
And so that I think kind of changed the narrative a little, and for some folks in the last week or two, where they were sort of believing there's a Fed put and a Trump put, and now maybe those are not as powerful. I didn't mention that in the upfront part, but we also wrote in the outlook that I didn't think the Fed, I don't want to say you fight the Fed, but what did we learn in the last interest rate cycle? We learned that as soon as they were close to being done hiking, more than halfway done hiking, you could get bullish again because you were closer to the end of the cycle than the beginning. Well, I think the same thing's true on the other side. Like at some point, you're not excited that they keep cutting. You feel like you're kind of toward the end of the accommodation cycle. So I kind of felt like you're not going to get as much multiple expansion from the Fed cutting at this point too. And so that narrative changed on the bull case as well.
Hey, the other thing, a listener asked a question about Ozempic. He said, "Gosh, is Ozempic going to blow up the economy? Everybody's going to get healthier and live longer, and Social Security is hosed. Like, what's your thought about that?"
Yeah, so I guess I'll give you a window into how we think about analyzing stocks in our business, right? So every day for the biggest 3,000 U.S. equities, we download or compute hundreds of things, balance sheet, income statement, cash flow, valuation, sentiment, accounting, ownership, whatever. And then the things we compute, you always have to be nimble and try to say, okay, what could be moving stocks? Is it a GLP-1 basket, which is what Ozempic is? Is it an AI semiconductor basket, which didn't exist on planet Earth till 2.5 years ago, right? So I know everyone is now, focused on it rightfully. I'm sure we're going to get into that, but like nobody was tagging stocks, are they an AI, semiconductor company before May of 23, right? So most risk management services are going to have basic things about a portfolio, but they're not going to have things like Ozempic. And so you have to be nimble. And so what we do is we search every earnings call transcript, every a webcast, at website of the public companies and create baskets using natural language processing to say, like, is this company a beneficiary or impacted by GLP-1? There's two sort of sides to it. One, who are the beneficiaries? Lilly, on others, maybe Sarepta is going to be hurt. Maybe Viking Therapeutics is going to be hurt. It really depends on it goes from a injectable to an oral. There's a lot of like healthcare side, but I think more importantly is also like you've seen Pepsi and Coke and Brown-Forman, which is Jack Daniels, and others get hurt because people think there'll be consumption challenges. So you want to look at how those stocks are trading and not say, oh, I like Pepsi because it's cheap. Like you have to take a step back and say, like, are people saying 30% less people are going to consume 20% less calories in the Frito-Lay business, and that's a 6% kind of hit or one year hit or something like that. So that's just an example of how you have to try to think about what's in the price and how those stocks are correlated and what's happening. Because if you're short Lilly and long Pepsi, you're Texas hedged the GLP factor.
Yeah, totally.
Yeah.
Well, it's interesting. You mentioned the AI, semiconductor index, and it's only 2.5 years old. And look, we've seen kind of the haves and have-nots there. Intel's gotten totally smoked there. They totally missed it. And now they've literally just hired a new CEO, Lip Bhutan,
Right.
who comes from Cadence, and the stock popped on that. Like, what do you think about these, everyone else besides NVIDIA,
Yeah. Well, there's a couple things to unpack in that question, Alec, right? Because I mean, Intel, if I was unemotional, and again, you mentioned I used to cover semiconductors for a long time, so I knew Intel's history really well, and I don't know the new CEO, but I will say if I was just being mathematical and I summed up their cumulative capital spending, cumulative R&D, cumulative dollars spent on M&A, they're probably the biggest destroyer of capital and the worst stewards of capital of any public company ever. Right.
Wow.
I mean, if you really think
that's
about
impressive.
Yeah. I mean, they were over 100 billion market cap 25 years ago when NVIDIA and AMD were 1 billion cap. Right. So
Yeah.
it just is an example of how the cumulative impact of technology can really change fortunes of companies. And there were everything wrong with it, hubris and debt. Right. And if I've learned anything about what makes a bad company, it's you get arrogant and you had to take on debt. And so Intel had all those issues. Right. And it went from when we were younger, Intel Inside was one of the greatest marketing ideas of all time. People didn't know if they had a Dell or a Hewlett box. They just knew there was an Intel chip inside of it. And they went to and also ran. I mean, they're not even a top 10 kind of relevant semiconductor company. So I think people are hoping that with a new CEO from a great business that they can, and they've had some kind of chip backed and government intervention sort of guarantees and stuff that people are hoping they're on a new trajectory. But I think when I think about semis, I'll give you another window in how we try to tag the stocks. So in March of 23, and this was a little lucky because it was before NVIDIA's first upward sales revision from AI chips, we created a basket by, again, searching every earnings call transcript, looking for the words AI. What we did, and this was actually early, although it'll seem like it was obvious, but it wasn't. We typed into ChatGPT in March of 23, give me terms related to AI. And it listed, large language model, it listed, you know, GPU and other things related to it. So we searched every earnings call transcript for any mentions of those and created a basket. What quickly happened after NVIDIA's upward revision was every management team got hip to the fact that they should use the letters AI in their speech. So we had to shift only to not the management's presentation, but only the Q&A portion of the earnings call, because ostensibly, if the analyst is asking about it, there's something relevant. And we also got rid of the word AI, so they had to be asking about, hey, tell us about no llama, or tell us about your new LLM, or tell us about something that indicated that they were doing something that impact. Tell us about Blackwell, or something that indicated there was a. And so you start getting smarter as you do that natural language processing to come up with the relevant terms to search for. So we have a basket of stocks that are AI semis. We track their forecasted revenue, their margins, their multiples, et cetera. And there's a number of stocks in there, including Cadence, by the way, where you mentioned the new Intel CEO came from. Those are EDA companies, Synopsys and Cadence. Synopsys is in a deal with Ansys, which has some technology. So that's one way I get at it. And then two, I guess, is, this is harder, and this would be holy grail, would be, can you tag every one of the top 3,000 U.S. equities as, are they a beneficiary, are they disrupted, or are they impregnable, right? Because I could see a world where we end up with like a bimodal distribution where impregnable companies trade at higher multiples, disrupted, are screwed, and then the beneficiaries trade at higher multiples. And it's not, I could have told you 2.5 years ago, well, I think Pepsi will be impregnable, right? And so I weave that back into your Ozempic question or GLP question, because if you had asked me 3 years ago, I said, well, Frito-Lay is an amazing business. Like, I'll own that all day long if I could, PA, because people like salty snacks in every region of the world, and that's a good biz. But so it's impregnable. And then it turned out this other thing happened with GLP, and now there's this romantic dream that we'll all take pills to drop 12 pounds before our daughter's weddings or whatever, and then we'll get off it and there'll be no side effects, or whatever starts to get into Lily's price. So I think the AI thing you really have to track carefully. There's also an AI software basket, like, what you have to think about. So there'll be the physical product and the software around it. There's the infrastructure. I also, just because you're such a risk expert, so this will resonate with you, but like, every growth manager in the world who buys U.S. equities identifies themes they like. I think AI semis will grow above the S&P. Compute was GDP plus 2%. Now it's GDP plus 7. I need exposure to that. Okay. I like electrification industrials. I think electricity works. Okay. I like power and utilities because I need to power the data center. Okay. What you saw, and I'm sure we're going to head there, but what you saw in that DeepSeek Monday, several weeks ago, was all the major stocks in every one of those growth themes was highly correlated to each other. So NVIDIA traded like Vistra in the power space, traded like Eaton in electrification industrials, and so forth and so on. So the whole complex had an impact on the market that was pretty great. And so I think when you think about your semis exposure, you have to think about it in the context of what's the beta, how much bounce does it have, like what's it going to do to the market, and how correlated is the other growth themes in the market. So we try to come at it from a bunch of different ways. I was just trying to give you a little window into that.
Yeah, no, that's cool.
Yeah.
Well, a couple things there. One is, look, sometimes you want to find the D- student who's going to become a B- student, and maybe that's Intel, right? As opposed to the A- student who's going to become an A student. So that's
change matters more than level, for sure.
Yeah. So that could be it. I'd like to separate kind of politics and policies a little bit, right? So obviously there's a whole bunch of, war of words going on out there, but in the end, it's going to be the policies that end up mattering and kind of impacting the stocks. And I think, you brought up DeepSeek. And look, I think personally as an AI expert, I think a lot of what happened there was to some degree overblown. With DeepSeek itself, it became more like an excuse to allow certain stocks that had levitated to sell off. So a great example is, a lot of the headlines are, they only spent $5 million to train. Well, that was like the prior day, right? It wasn't like their entire time of training. They owned $200 million in chips, and this was the latest version of the model. The other thing that came out later was they were actually against the terms of service, using OpenAI to help train the DeepSeek model, right? So that's obviously not something that's they're going to be able to do forever. But so let's talk a little bit about trade policies and their potential impact, right? So we've got 200% tariffs slapped on wine from Europe, and like all kinds of stuff going on there. What's the end game here? What does this look like, over the next 6 months?
It's funny you say 6 months because I think most of our minds kind of think that eventually things have to improve 6 months from now, and that you can't live in this state of uncertainty like interminably. And I don't know. I mean, Trump seems pretty committed. I was listening to Secretary Mnuchin, former Secretary Mnuchin, on a Bloomberg radio interview early this morning. I guess replaying what he said yesterday, and Trump's been pretty consistent about wanting to collect tariff revenue, and that can amount to really big dollars over time. So I hate arguing with the poly market because it was right in every single election, but I'm a little surprised when I checked yesterday. It was 38% probability of a tariff above 5% sustained for the first 6 months of this year. Like that seems low to me.
Yeah.
But the thing was right in every state on every election, because it's a gambling state. So, but it seems like he's committed to that to try to create some revenue, I'm not sure he'll cave on. I didn't know about the wine in Europe thing, but I'm not sure he's going to cave on those kind of things. I think it.
Yeah. No,
Yeah,
I'm not saying cave, but I think, you look at the fentanyl numbers are dropping. They're the lowest in 2 years. That's
yeah.
been kind of one of his talking points. So I guess we'll see, right?
I think the consumer's slowing. Okay, and I think if
Yeah,
you're CEO of
definitely.
a big company and you have plants in Mexico and plants in the U.S. and customers in Canada and Asia, I think you're a little bit pausing on how to deploy capital, and that's why I think it's a little early to get bullish on equities, just because
Yeah.
I need to see what they guide, what they say is happening to their businesses, capital spending, inventory, forecasted revenue, what their customers are telling them. And I think the shorter term data points, things are kind of slowing.
Yeah, that makes
So
sense.
that worries me a little, but I think the policy stuff, the other point, Alex, is like, I don't know if this is more than like 18 months before you start focusing on the midterm elections. And then in a weird way, the Trump controlled money and power might have a different lens on it, and I'm not a
Yeah.
politics guy at all, but I just think about what could cause if I've learned anything about the equity market in the last 25 years of studying it, two things matter: changes to the perception about growth and changes to the perception about rates. And they drive a lot. And so you can compute that. You can look at the Fed fund futures and see what it does to the price of forward earnings of equities and those kind of things. And so I think right now the changes to the perception about growth are lower. In November at the election, they were higher, right? And so
Yeah.
we
No,
need
that's
to kind
totally
of,
true.
and that's we need to get on that
Yeah.
other side of people being like, wait a minute, less regulation, I can see, or whoa, the tax, we're going to put a tax bill up before Easter, and maybe that gets people saying, all right, lower taxes. Like, so there could be something that changes that perception about growth coming, and that would create a more bullish environment.
Yeah.
Yeah.
Yeah. I think if they're going to do, I think the administration came in thinking, hey, if we're going to do damage to the market, let's do it now, not before the midterm. So I
I
think
mean,
that
you
was
definitely don't
pretty
want to do it.
calculated.
Yeah, you don't want to do it, 6 or 9 months before the
Yeah.
next
Yeah.
presidential election. But I think it's even more than that. I think this administration believes that the tariffs are a source of revenue, and that the U.S. has been kind of a net loser on certain things that they shouldn't be, and so it's setting out to correct that. And we'll see if that turns out to be absorbed okay by the market. It might, and it's a little
Yeah.
bit hard for me to, just focusing only on the stock part. It's a little bit hard for me to say that's bad. I think it's for the CEO of a 70 billion market cap industrial company or something, or whatever you put. I think it's trickier right now about, okay, do I move employees into the U.S. from Mexico if I have that choice, or that stuff's a little trickier. And I
Yeah.
think that's why you get a soft pocket a little bit in the economy until we get a little more certainty. And I think that's 6 months, in the next 6 months.
Yeah, that makes sense.
Yeah.
Well, let's go back and talk more about tech. I mean, I think there's a super interesting theme. I got a question from an audience member here. It's basically asking about, look, GPU performance has increased a lot. It may hit a wall over the next few years. We've heard a lot of people talk about that, kind of similar to, it's basically been following Moore's law, and it's approaching kind of the end of the road there, right? And at the same time, what's interesting about these advanced large language models is to get them better. It's not like, hey, double the power and they're going to be twice as good. It's like 10 times the power and we can improve by 3%, right? Like the numbers are going in the wrong direction for that. So just curious what your thoughts are there on impact for stocks like NVIDIA and these other companies trying to make GPUs or special chips to run AI. Like, what does that look like?
Yeah, there's a couple ways I'm thinking about answering your question, and I guess they'll be consistent thematically to how do we do stuff. But I started this year. Gartner, which is a kind of a well-known IT consulting firm, came out with their 10 technology trends for 2025 and beyond. And so what we did is we searched every earnings call transcript, every website, every company presentation, every 10K and 10Q for any evidence of these trends. So these are things like spatial computing, agentic AI, ambient computing, post-quantum cryptography, polyfunctional robots, all these disinformation security, et cetera, et cetera. And so we create a basket of each one of those, again, tracking the forecasted revenue, the margins, the multiples, the changes, whatever. So, I think agents are going to be the next trend, and you see a lot of even buy-siders trying to figure out if they can implement that and get an agent to read in all the sell-side research for you and summarize it in 1 second. There's a lot of examples. So I think the answer is compute is going to grow way above GDP and way above what it did historically for the next several years. I think that's the most certain thing about this kind of AI revolution. When I happened to randomly, I was scheduled to be on CNBC the day of the DeepSeek Monday. I was a little bit shocked how, some people who, look, I have a PhD in statistics. I covered chips for a long time. My answer was, I'm like a quasi-informed, aspirationally average person on this topic. Like, I don't know. And then other people who I didn't think had any background were saying with confidence what they knew DeepSeek meant 2 hours after first hearing about it. So I was sort of envious of their assertion. But I think in the end, my conclusion was it's good for compute. And ultimately, semiconductors will work. If you're looking at NVIDIA right now as a stock, and I think it's really hard to know something about NVIDIA that nobody else knows, but I would just say this, like, I have to like it more today than I did in January 1st. And the reason is Morgan Stanley's tech conference 2 weeks ago, every company affirmed their CapEx. Nobody said we're cutting back on our CapEx. And I mean across the hyperscalers, Microsoft, Google, everybody. NVIDIA's revenue is extremely tied to that capital spending.
Yeah.
The stock's down 149 on January 6th to wherever it is right now. I can't look. I don't want to screw up our video, but let's say 114 when it was at the close.
Yeah, that's about right.
So the stock's down 25% from highs, maybe more, 28% from highs. And the relative revenue estimate achievability looks better now than it did then, particularly relative to everything else in the market where we know things are slowing. So I think ultimately semis will get their day in the sun for a nice trade. I think it'll be this year. I think the challenge is some of the other semis that don't really do AI that are in the industrial. You saw AVGO, you saw Broadcom's quarter was pretty good. Stock popped on that. I think the challenge is a lot of the industrial stuff and the consumer stuff is slowing a little bit. And those businesses, ADI, Microchip, Texan, others have a lot of inventory still. So it's not as like a clean cycle as it used to be. I think you have to focus on the AI companies that benefit in the medium to long term and just bet on the fact that compute's going to grow above GDP. One of the thoughts to your question is like, ultimately, I think quantum comes. And if you want to see the craziest stocks in the market, look at these post-quantum cryptography stocks. Like these are things where like after there's quantum, then you'll need security for it, right? So
Right.
Rigetti and Ionic and some of these stocks that went from 1 to 20 to 6 to 14 in like 6 weeks, right?
Yeah.
So
Wild.
because people don't know, I happen to pick Rigetti RGTI as the ticker and look at what the consensus sell side estimates were. And it's like, I'm making up the numbers now, but plus or minus like 50 million, 70 million, 80 million, 90 million in the next 4 years, and then like 600 million or 800 million. Like people have no idea, but they know at some point there's going to be a revenue, kind of hockey stick, and they're just kind of gambling on what that is. So I think quantum will be next. I mean, you saw Harvard get like a 90 million donation for quantum. There's definitely companies investing in that. That'll enable a lot of, data ingestion and manipulation at higher rates. I'm super bullish. We can talk about it if you want on the healthcare sector in terms of.
Yeah, no, I definitely want to. I was going to ask you. Next question was kind of what are your favorite few sectors right now? If you want to talk, let's kick it off with healthcare. Awesome.
Yeah. Well, it just was a segue because I was thinking about the compute. I mean, to me, healthcare has been the best performing sector this year, but it has nothing to do with why I like it. It's been a little bit lucky. It's worked on a defensive trade, not where I think it could actually be offense. I mean, I think the ultimate bull case for equities and what could get the market correcting a little bit would be any proof case for a company deploying predictive analytics to drive margins higher. Stocks go up when margins go up. Healthcare industry has tons of companies with lots of employees, high revenue dollars, and low margins. McKesson's a drug distributor that probably is not a household name as a stock, certainly wouldn't make a retail sexy stock list. They're a 350 billion revenue company, pass-through drug distributor with 1% net margin. If they get better at predicting customer and employee behavior and the margins go to 1.5% from one, that's 50% earnings growth, everyone. So there's a lot of those kind of stocks in the healthcare sector, whether it's Quest or Cencora or Cardinal or even United Health, which obviously had the disaster with their CEO. And, we just think about it like a human being. Like, I'm a small business. We use United Oxford. Should I be embedding in my business plan that they're going to cut pricing for me next year? Hell no. Pricing is going to be up like 9% next year. And I will Oliver Twist, thank you, sir, can I have some more? Like, I have no choice. So like, those businesses have revenue per share has grown for every S&P 500, for the S&P 500 healthcare every year for the last 20 years in a row, including COVID, including financial crisis. It's a stable business with high demand, good demographics, whatever. And I think there's a lot of margin potential there. It also is an M&A beneficiary. I think the street came into this year, and we wrote this in our year ahead outlook in early January, that they assumed RFK was going to wreck the healthcare sector earnings, but didn't assume any other policy was going to hurt earnings anywhere else. And so that's why we made the call of, we like healthcare, like the relative estimate achievability seemed offsides. I always think about the fact that Jamie Dimon at JP Morgan and Buffett at Berkshire and Bezos at Amazon 10 years ago tried to create their own healthcare consortium, and then they kind of gave up. So if you think this RFK is going to come in and dramatically change the healthcare sector, it's not that easy to do, implement that. So I'm sort of thinking their estimates are more achievable. And then medium to long term, you can get really crazy and pulled up and lathered up about, compounds, and Google's computational chemistry business is probably a $500 billion market cap company in 10 years. So I think there's a lot of real dreamy things. I mean, I'll give one example to the listeners, but think about breast cancer detection, right? There's a marker called dense tissue, and it's associated with a higher probability of breast cancer. If you gave 100 radiologists who are experts films to look at, say 100 films, some of the 100 would think only 6% have dense tissue, and others would think 38% do. And these are experts looking at the same films. So the problem with that is you get a lot of type 1, type 2 error. You do prophylactic double mastectomies and the resulting cosmetic surgery, the pain, the cost, all that stuff when you don't need to, right? If you read every image, remember, women get regular checkups, they get images. So there's just millions of data points from different angles. You could read it into these imaging AI algorithms and get much more accurate results. The radiologists have more time to spend with the patients. Like, everybody wins. And so that's an easy example because of the data, and it's already happening, being implemented, all over the place. And I think there's so many examples of that where you'll be efficiency. I'll leave you with one thought about healthcare. When you walk into a doctor, right, and just think like you're an AI expert. What do they often do? They hand you a clipboard. And
Unbelievable,
pen,
right?
And they say, write stuff down. And you should be thinking to yourself, you should almost look at the person and say, this is not 1985. What are you doing here? Scan my retina, know all my information, and let's get in there and do something. There's got to be something better than circling with a big pen your typewritten out document on your.
I got two cool things for you. One is, at least our AI system can take a picture of that clipboard, ingest everything, and you're done. So it actually, you don't have to type it on a screen. So that's kind of cool, right?
Think about Axon, like the police report. Why would a policeman go back and write stuff up? It's all filmed. It's all, there's so many examples of that. But anyway, sorry, go ahead.
Yeah. And then, and the other one is your whole, I want to read all the Wall Street research. Yeah, we got that already.
Totally. And I think that stuff's happening everywhere. And it's making certain things an anachronism, right? And so, I took an AI for healthcare course online at MIT last summer. It was kind of a pain, 6 to 8 hours a week, 6 weeks. But, and I admit this, I came back mesmerized, like the virginal analyst who thinks everything's awesome. And if I talk to grizzled healthcare veterans, oh man, that doesn't work. And they've been scarred in the stock market by hearing some of these stories. So I admit the truth's probably in between, but I just came back excited, like MIT's got this, what, an emerald box or something, and it goes on the wall, and it's like a wearable multiplied by 1,000. It's going to know, is every home built in 10 or 15 years from now going to have one of these on the wall? Maybe. It tracks your electromagnetic waves. It knows when you go to the bathroom, when you breathe, your heart. It's like the ability, it could send you emails saying, yo, Alec, get some XYZ. The ability for you to live more productive years because of this healthcare technology combo, I think, is going to be massive. So, answering your question about what sector, it's healthcare. Healthcare has been our number one sector this year. And I think it's going to be structural, meaning I don't want to be tethered, but Do I think it has a chance to be the best performing sector over the next 5 or 10 years? Yeah, I do,
Yeah.
because of its inefficiency and productivity potential. And and so that's sort of like a long term thesis. The shorter term sector I like is industrials, but it's much more tactical
Yeah, I
on
gotcha.
like anniversarying low comps and that kind of stuff. Yeah.
Well, look, you just started Trivector really with a focus on individual investors, wealth managers,
Right.
financial analysts. So tell us a little bit about that and how our listeners can get a hold of your research.
Yeah, no, thanks for that. I appreciate it. So www.trivectorresearch.com, Trivector. So vector being magnitude and direction. We're trying to get the magnitude direction of the market. And the tri part is, because I've experienced doing both three things, macro, fundamental, and quant. We put together this Trivector research business. We just launched it a couple weeks ago. It's $100 bucks a month, $1,200 a year to get our content. So we write stock ideas, sector and ETF ideas, market risks. We do monthly webcasts where anyone can ask us questions. Subscribers can, which they seem to like, because I think a lot of people won't take the questions, and I like the questions. We have a website, so just go to the website and subscribe. www.trivectorresearch.com. We'll 2 to 3 times a week we write stuff, or we send out videos. We do a ton of traditional and social media, so LinkedIn and X, etc. So I'd love for people to subscribe and check it out.
Awesome. Well, Adam, thanks for coming on the show today. Great to have you.
Yeah, great to see you, and I'm thrilled to see what you're doing with your pursuits. So great to catch up.
Great to catch up. All right, thanks everyone. This is the end of our live show, and we'll see you all soon. All right, perfecto. All right, so that's